Hello students, welcome to your Commerce online class. This is the continuation of the chapter Partnership. Today we'll learn types of partnership. There are four kinds of partnership. The first one is general partnership. In general partnership, the liability of each partner is unlimited. By now you must have learned the meaning of liability. Liability is what you have to give to others, what you have to pay to your creditors, to your suppliers, to the bank from whom you have taken loan. And so in general partnership, the liability of each partner is unlimited. And if there is any dues which has to be cleared, the dues of the creditors, and if the amount does not, after selling the assets of the company, if the amount is not enough to fulfill the dues, then even the personal property of the partners will be taken away. But there is an exception in the case of minor partners. The liability of the minor partner is limited to the amount of his share in capital and profits of the firm. So if the capital investment of the minor is 1 lakh, then the liability will not cross 1 lakh. Or if the share of the profit of the minor is 1/10, so the liability will not exceed to 1/10. In general, in India, all the partnership firms are general partnership. Each partner of general partnership is entitled to take active part in the management unless otherwise decided by the other partner. So in general partnership, each and every partner is active and they take an active part, or it is decided by the other partner how much will be the liability of that each partner. So the first types of partnership is general partnership, where the liability of each partner is unlimited, but for the minor the liability is limited. Second, we have limited liability partnership, LLP. Limited partnership is now allowed in India under Limited Liability Partnership Act 2008. So LLP is allowed in India under this act, which is called as Limited Liability Partnership Act 2008. Now what are the chief characteristics of this type of partnership? Number one, Unlimited Liability Partnership, LLP, must be registered under the act with minimum 2 partners. So we have learned the process of registration. The partners, they have to register themselves in the registrar office, in the main office of the state, and so minimum 2 partners and maximum can go to 10, 20. Point 2, an LLP is a body corporate having separate legal entity and perpetual succession. Okay, now we had said that partnership has no legal existence, which means that the partnership and the firm is one and the same. But as per the LLP, the new characteristics of the partnership firm is that the firm can have a separate legal entity. The firm can have its own identity. Like when you enter into the contract, you will not enter into the contract as individuals. You will enter into the contract in the name of the firm. So a firm, even though it is dead means it is not like a human being, but they can represent themselves, the firm, like an artificial person can represent themselves to enter into any contract. Like for example, we have 2 partners, Ram and Shyam. So they have a company, Ram and Shyam Traders. So when they enter into the contract, they enter into the contract as Ram and Shyam Traders. So their company has got a separate identity just like a human being. But since it is not alive, so we call it as an artificial person having an separate identity, and it will even get a perpetual succession. Perpetual succession means even if there is a death of partner, even if there is retirement, or even there is insolvency, if the partners do not have money, one of the partner do not have money to run the business, so more partners can join in and the business will go on and on. Perpetual succession until unless there is no final closing down of the business. So perpetual succession means even if there is death, there is retirement, or anything in which the partner will leave the company, the firm, but still with the addition of the other partners, the firm will go on and on. Point number 3, in an LLP, the liability of partners is limited to their aggregate contribution to LLP. So here the liability is limited, whatever they have agreed in the contract. Okay, so if there are 3 partners and all 3 have agreed equal contribution, so everybody will be getting, everybody's liability will be equal, 1/3, 1/3, 1/3. No partner would be liable on account of any unauthorized or independent actions of other partner. So if there is any unauthorized action that has been taken by the other partner, like B has done something which is unauthorized, so A will not be responsible for that. Okay. Number 4, an LLP must maintain annual accounts reflecting the true and fair view of its state of affairs. So LLP, they have to maintain the accounts and they have to present this true picture to the government whenever there is audit. The liability of partners and firm would become unlimited in case the firm or its partner carry out any act with intention to defraud the creditors or any other person or for any fraudulent purpose. Here we said that LLP, the liability is limited to the extent of the contribution. But if any of the partner, they try to do any fraud act with the creditors. Now creditors, suppliers are the one from whom they take money. So if they defraud, if they do some kind of cheating purpose to the creditors, then what will happen? The liability of the partners of the firm will become unlimited. Thus, LLP is a hybrid form of business organization combining both the features of partnership firm and joint stock company. So, LLP is little bigger than normal partnership. It is a combination of partnership and joint stock company. Partnership, minimum 2 has to be registered. The liabilities may be limited, but if there is any kind of fraud act done to the creditors, then it will become unlimited. It has to show accounts, the true picture of the accounts, annual accounts, and it has got a separate legal entity and perpetual succession. Now, what are the advantages of limited liability partnership? Number 1, an LLP is a separate legal entity independent of the partners. It is capable of owning and holding property in its own name. So here the firm has got separate identity. It can buy land, property, or anything in its own name, like the name of the firm or company. Number 2, it is much more stable than general partnership because it is not dissolved by the retirement, insolvency, death, etc. of a partner. It enjoys perpetual succession. So perpetual succession, even if there is a retirement, insolvency, means the partners don't have money to run the business, bankrupt, or death of the partner, it will not close down. Okay, it will enjoy perpetual succession, means it will go, the business will go on and on. Number 3, the liability of the partner is in LLP is limited. They have not to take unlimited risk. So in LLP, the liability is limited. Number 4, as there is no limit of the number of partners, an LLP can raise huge funds for expansion and growth of business. So here the partners, minimum to maximum, no limit. So as more and more partners can join in, more and more funds can be added, and there can be expansion and growth of the business. Number 5, a body corporate can be partner in LLP. Now disadvantages. Number 1, it has to be registered under the Act, and for this, time, money, it takes lots of time and money in the documents and the formalities. Number 2, there is less secrecy of business affairs as it has to fulfill legal requirements. Now you cannot keep the secret of the business, because you have to, in the paperwork, you have to tell about the business, and time to time you have to show your accounts to the auditor. Credit standing of the LLP is reduced due to limited liability of the partners. Okay, so credit standing means how much you can get money from the bank. It depends upon how much you are able to pay. Okay, so from the bank or from the creditors, when you take money, when you owe money from them, it all depends on what is your credit standing. Credit standing means how much you can repay back. So since the liability of the partner is limited, nobody will be wanting to pay more. Okay, so since each and every partner, they are ready to pay only limited amount of money as dues to the creditors or the suppliers, so the credit standing is less. Like if you have a credit standing, means if you are willing and power to repay back, you have, like if you want to take loan of, let us say 10 lakhs, but you don't have that capacity of paying back, so you will take less amount of loan. In the same way, since the liability of the partners is less, if you take excess money or excess goods on credit from the supplier, it might go to unlimited extent. But here, since the liability of the partners are unlimited, there is less credit standing of LLP. There is less flexibility of operation due to some legal formality. The liability of the firms and its partner would become unlimited in case the firms or its partner carry out any act with the intention to defraud the creditors or any person or for any fraudulent purpose. So this is the disadvantage. The liability is limited, but if any of the partner does any fraudulent act to the creditors, then the liability will become unlimited. Number 3, partnership at will. A partnership formed for an indefinite period. Okay, the time period or purpose of the firm is not mentioned at the time of formation. It can continue for any length of time depending upon the will of the partner. It can be dissolved by any partner by giving a notice to other partners of his desire to quit the firm. So partnership at will is for indefinite period, and the time is not mentioned. In the time of the formation is not mentioned, and depending on the will of the partner, it will continue, and if any one of the partner does not wish, they will give notice to the other partner and they can leave the firm. Number 4, particular partnership. It is a partnership formed for a specific period or specific objective. It is automatically dissolved on the expiry of specified period or on completion of specific purpose for which it was formed, like construction of road, of dam, canals. So here the partnership is formed for specific period, 5 years, 10 years, and when the work is done, automatically the partnership will dissolve. Now, so there are 4 types of partnership: general, LLP, at will, and we have the specific. Okay, we have the particular partnership. Now let us look into the types of partners. There can be following types of partner. Number 1, active or working. Such a partner contributes capital and also takes active part in the management. They have unlimited liability, and the active partner is known to everyone outside. Like they are known as the partners of the company. Okay, they are the full-fledged partner and they take an active part in the management. Number 2, sleeping or dormant partner. A sleeping or inactive partner, they simply contribute capital, money, and they don't take active part in the management, but they share the profit and losses, and their liability is also unlimited, and they are not known to the outside world. Okay, so active, inactive. Okay, sleeping, working. Secret partner. This type of partner, they contribute capital and they take part in the management. Okay, and they share profit and loss, and their liability is also unlimited, but they are not known to the outside world. Okay, so here the sleeping partner is also, they also contribute capital. Okay, but they do not take part in the management. And the secret partner, they contribute the capital but they take active part in the management. Both the sleeping and the secret partners are not known to the outside world. Number 4, limited partner. The liability of such partner is limited to the extent of his share in capital and profit of the firm. So how much will be the capital investment and the share of profit in the firm? To that extent only the liability is limited. He is entitled to take active part in the management. The firm is not dissolved in the event of his death, lunacy or bankrupt. So the limited partner, their liability is limited to the share in capital and profits of the firm. They do not take active part in the management, and even if they die or they become bankrupt, or if mentally they become if they have mental disability during the time, so still there is no effect on the dissolving of the firm or closing of the firm. Number 5, partner in profits only. This type of partner, they share only profits, not the losses, but their liabilities are unlimited and they are not allowed to take part in the management. Okay, so these partners associate only for money and goodwill. Like they just have to show their presence in the company so that the company will have a goodwill. So they are the partners only to get the profits. Okay. Number 6, nominal or ostensible or quasi partner. Such partner, they neither contribute capital nor they take part in the management. Neither they share the profit and losses of the fund of the firm. They only give their name and reputation for the benefit of the firm. So nominal or quasi partner is, they don't contribute capital, neither they participate in the management, nor they take any profit from the company, but they give only their name and reputation for the benefit of the firm. He represents himself or knowingly allows himself to be represented as a partner. and he becomes liable to outsider for the debts of the firm. Okay, so nominal or quasi partner is they don't contribute capital, neither they participate in the management of the business, nor they share profit and losses, but they only lend their name and reputation for the benefit of the business. Two types of nominal partner: partner by estoppel. A person who by his word, spoken or written, or conduct represent himself as partner becomes liable to those who advance money to the firm on the basis of such representation. He cannot avoid the consequences of the previous act. So first type of nominal partner is partner by estoppel. Example is given here. Suppose a rich man Mohan is not a partner but tells Sohan that he is partner of the firm called Shipra Enterprise. So Mohan is only giving name and representing himself to be as partner of Shipra Enterprise. So he tells Sohan that he is the partner of Shipra Enterprise. On this impression, Sohan sells good worth 20,000 to the firm. So Mohan is a rich man and he's very well known. So he tells to Sohan that I am the partner of the Shipra Enterprise. So why don't you sell your goods? So what Sohan did? Sohan saw that Mohan was the partner, but Mohan is not the actual partner. He is just representing himself as a partner of Shipra Enterprise. He sold the goods worth 20,000. Later on, the firm is unable to pay the amount. Sohan can recover the amount from Mohan. Here Mohan is partner by estoppel. Okay, since Mohan in his words spoken, or maybe he had written down, he represented himself as a partner of Shipra Enterprise. So Sohan, thinking that Mohan was the partner, he sold goods worth 20,000, but the firm is unable to pay the amount. So now Sohan will recover the amount from Mohan. So here Mohan becomes partner by estoppel. Second type of nominal partner, partner by holding out. When a person is declared as partner and he does not deny this even after becoming aware of it, he becomes liable to third parties who lent money or credit to the firm on the basis of such declaration. Let us understand this with example. Suppose Shipra tells Sohan in the presence of Mohan that Mohan is partner in the firm of Shipra Enterprise. Now, partner by estoppel was Mohan himself was telling that I am the partner of Shipra Enterprise. But here Shipra is telling Sohan that Mohan is partner of Shipra Enterprise, and Mohan stays quiet, does not deny. Later on, Sohan gives loan to Shipra Enterprise 20,000 with the impression that Mohan is the partner, because when Shipra was telling Sohan that Mohan is partner, Mohan was staying quiet, and on this impression Sohan gave 20,000 loan to Shipra Enterprise. Now the firm fails to repay the loan to Sohan. So again here Mohan is liable to pay 20,000 to Sohan, and Mohan is the partner by holding out. Okay, so in partner by estoppel, Mohan himself said that I am partner, but Shipra Enterprise was not able to pay money, so Mohan had to pay to Sohan. Partner by holding out, the firm is telling that he is our partner, but the Mohan who is not the partner is staying quiet. So when the firm is not able to pay back the loan, then Sohan can demand it from Mohan. Number 7, minor as a partner. A minor is a person who has completed 18 years of age. Who has not completed 18 years of age. A minor cannot become partner because they are not qualified to enter into a contract. But he may be admitted to benefit the partnership with mutual consent of other partner. Okay. So on being so admitted, a minor can entitle the share of profit, and minor can inspect and copy the book of accounts of the firm but cannot take active part. Okay. The liability is also limited to the extent of share and profits, share in capital and profits of the firm. A minor cannot file a case against the firm or its partner to get his share except when he wants to disassociate himself from the firm. Okay. So a minor cannot file a case against the firm or its partner to get his share except he wants to get away from that firm. After becoming major, the minor must give public notice within 6 months if he wants to break off his connection with the partnership firm. If he does not give such notice within 6 months, and if he decides to remain in the firm, he becomes liable to an unlimited extent for the debts of the firm from the date he was admitted to the benefits of the partnership. So when this minor crosses 18 years and becomes major, he or she has to give a public notice within 6 months that they want to break off their connection with the partnership firm. But if they fail to give such kind of notice, the liability from the beginning, from the time they were getting the profit or benefit, the liability will become unlimited. He also becomes entitled to take active part in the management of the business firm, of the firm's business. Okay. So a minor partner who has not completed 18 years and they cannot enter into a contract, their liability is limited, but they are allowed to inspect the books of account, but they cannot take active part in the firm's management. When they become major, within six months they have to give a notice that they want to break off their connection with the partnership. If they don't do so, their liability will become unlimited and they will have to pay all the amounts from the time they are earning benefit. And the last one we have here is sub-partner. He is a third partner with whom partner agrees to share his profit desired from the firm. He does not take part in the management of the firm. He is not liable to firm's debts. So the sub-partner is any third partner who maybe is benefiting the partnership. So neither they take part in the management nor they are liable to the firm's debts, but they are the one who get the share of the profit, okay, that is desired from the firm. Okay, so today we learned the types of partnership and types of partner. Have a good day and take care of yourselves.